Okay, and so now we're on to chapter 10, but I wanted to bring up something at this point in the class. What you've noticed, or hopefully you've picked up on, is that what we're doing is we're drilling down on each. Now that we've looked at the global picture in terms of personal finance and paying yourself first and all these other concepts that we had talked about, including budgets, etc., and what we're embarking upon for the last few chapters at any rate, as we're drilling down on certain specific areas within the framework of your personal finance, in terms of your personal finance life, if you will. And these are things that you will be coming across periodically throughout your life. So these will keep coming up over and over again in terms of like home purchases and vehicle purchases, and hopefully not too much, but and certainly moving along in that within the context of that framework. In chapter 10, we're looking at property, home, etc., and motor vehicle insurance. So onward we go. So with chapter 10, our learning objectives are developing a risk management plan in using insurance. So the reason, just a quick overview of what insurance is all about. Insurance is to protect you against there's a likelihood that something will happen, but not something out there to protect you against that. Those things that you really can't alter, things that happen, accidents, right? This is the intent behind insurance. The insurance principle, in fact, addresses just that. That you are gambling if you don't use insurance, and if you do use insurance, that hedges your bet a little bit. It provides you a little bit of wiggle room, a little bit of assurance that you will be able to be indemnified, to be able to get your losses covered, if you will. Anyway, so developing a risk management plan using that insurance, discuss the importance of property and liability insurance, explain the insurance coverages. These are all different aspects of insurance. Explain the insurance coverage and policy types available to homeowners and renters. Specifically, analyze the factors that influence the amount of coverage and the cost of home insurance. How much is too much? There's if your home is worth $150,000, you don't insure it for a replacement value in terms of $1 million, for example. You don't need that much insurance because you won't be able to collect on it at any rate. So what's the point? At any rate, again, identify the important types of automobile insurance coverage and evaluate the factors that affect the cost of automobile insurance. This is something that's near and dear to all of our hearts, especially in Michigan, with the current framework in terms of the change with the insurance changes that have just come about. So insurance management and insurance and risk management, rather, introduction. So what is insurance? Again, insurance is to protect against the possible financial loss. It gives you peace of mind, as we mentioned before. An insurance company or insurer is a risk-sharing firm that assumes financial responsibility for losses from an insured risk. People purchase the policy, the firm assumes the risk for a fee called a premium, which the insured policy pays periodically. So in effect, what you're doing is that you're paying a bit every month, and what the insurer, the company that's insuring you, is gambling that you'll get through that month without incurring losses that would far exceed that that monthly income, if you will, on their side. So this is all mathematically approached in terms of the likelihood that things will occur, and it's all based on what? On past experience. So the insurance company is there to make money, of course, and we know this for a fact because have you ever seen insurance commercials? There are aplenty out there. There are lots and lots of automobile insurance companies, for example, that are all the time. The Geico Gecko and Flow from I forget the other insurance. At any rate, we've all seen, or the General, for example. etc. All the insurance ads that are out there. So if a company can afford to pay for ad space, to pay for ads to promote their product, that means that it's something that is quite lucrative for the firm, because the insurance company has to pay for those ads. So just something to keep in mind. This is bringing the economics into the situation. Anyway, the firms collect these premiums in order to offset losses that for the larger number of people that are out there, right? So types of risks. Risk, the definition of risk is the uncertainty or lack of predictability, such as a loss that a person or property covered by insurance faces. So if you weren't covered by an umbrella called insurance, then you would be on the hook for the entire cost, the financial cost of whatever is happening, right? Peril is the cause of possible loss, such as fire, windstorm, explosions, robbery, accidents, and premature death. So this is what the risk that we could suffer would be the peril rather that is embedded in that risk are all the occurrences that happen on a regular, too bad, unfortunately, on a fairly regular basis. A hazard increases the likelihood of a loss, such as defective house wiring. And hazard is contrary, if you will, to the insurance principle, because that would include such things as, an example, you have health care insurance to cover you, but if you're going to go skydiving, for example, that would be hazardous. Not telling you not to do it, but there's hazard that's embedded in that goes above and beyond insurance, because with hazard, it's something that you can avoid. So by not going skydiving, by not smoking, by not eating too much, by not drinking too much, you can avoid some of the perils that are associated with, that are embedded in that risk. Anyways, just that thought. So hazard identifies those behaviors that are contrary to that insurance principle, if you will. Okay. So kind of encapsulating this whole concept of risk, there are people that are dedicated to categorizing, cataloging, quantifying, putting these into mathematical representations, if you will. And those are folks within the context of the insurance industry, where you develop such things as mortality tables, how long people will live based upon age and based upon various risk factors. And more specifically, they're called, this is the duty or the job, if you will, of an actuary. Actuaries are the ones that are the folks that put this information together. Good jobs, by the way. At any rate, onward we go. Risk management methods. So risk management is an organized strategy for protecting assets and people. This is something that's become a very, very hot topic across the board, and for most companies, most all enterprises, most all endeavors, whether we're talking at the, within the framework of the government or with businesses. Risk management has become a very, very important aspect of managing the day-to-day and the tactical and also the strategic long-term view. At any rate, risk management techniques include risk avoidance, risk reduction. An example of that, of course, would be like wearing a seatbelt, installing smoke alarms, eating a balanced diet and exercise, not drinking too much, not eating too much, getting your exercise, all these other things these are trying to reduce the impact of those risks, or to kind of keep you on the tail end, if you will, of these risk pools, doing what you can to reduce your risk, really. Risk assumption, this is self-insurance. This is where when we talk about self-insurance, means that you're not going to go to an outside source for your insurance. You're going to do this yourself. Risk shifting is the transfer of risk to an insurance company. And a deductible is a set amount that the policyholder must pay per loss on that insurance policy. So this has to do with everything from, typically when you think of deductibles, you think of health insurance, but it would be across the board, of course, for automobile and home, how much you're actually on the hook for, how much you're sharing. And so the more that you, the higher your deductible, if you will, the lower the cost of those premiums that you're paying. Anyway, so planning an insurance program, set your insurance goals. What is it that you actually need? How much insurance do you need? You don't need $1 million for $150,000 a home. You do need $150,000 or hopefully replacement value, because if the value of your home goes up and you have it for 20 years and the home goes from $150,000 to $350,000, sounds good, then the replacement value is going to go up. And if you only have $150,000 in coverage, your $200,000+ will stay short. So develop a plan to reach your goals. This is kind of what we're talking about, going around with this. Put your plan into action and check your results. Always with that last item is to recalibrate, reconsider. And it's the same with insurance. Insurance is a financial product like everything else, right? So property and liability insurance, first we're looking at the home type of a situation. Discuss the importance of property and liability insurance. So major disasters have caused catastrophic amounts of property loss in the U.S. We hear this all the time, right? Hurricanes, tornadoes, floods, and I'm sure the result of the spring thaw, for example, bring floods, etc. So there's always some disaster, catastrophe that's on the horizon, just over the horizon. Typically, we don't quite see it, but we know it is coming. Main risks related to home and automobile are property damage and responsibility for injuries to others and to their property, and of course yourself as well, right? So these are kind of putting the framework around what it is we're describing, why it is that we need this insurance, and what it is that we're actually insuring: your home, your property, your automobile, and the damage that is done to others while you're operating your vehicle, or people that are in your home, or etc. Anyway, you get the idea. So we're putting the framework around this. Potential property loss, when we're looking at such things again, is you're looking typically at higher dollar items, but it could be all of your belongings in your home are destroyed. So these are also things that have to be considered. So it's not just the high dollar items, it's also all the things that are put in inside of your property, inside of your home, inside of your vehicle, etc. So anyway, houses, automobile, furniture, clothing, and other personal belongings. The risks associated would be physical damage and caused by fires and etc. Right? The risk is that the loss of the use of whatever it is that you own due to such things as robbery, vandalism, or arson, where somebody actually does this to you, something that's, again, beyond your control. The first is accident, and the second is someone else that's stepping in and doing this to you, if you will. So liability protection. Liability is legal responsibility for financial cost of another person's losses or injuries. So we're looking at when you hear the term, you are liable for that, meaning that you are responsible for the damage inflicted upon another person, the financial cost, if you will. Negligence is the failure to take reasonable care, such as failure to supervise a child in a pool. That's quite the extreme, but nonetheless, it should be something that you have a role to play, there's always that reasonable test, meaning, would a reasonable person do this? Would a reasonable person be driving 120 miles an hour on on a country road or on in a freeway for that matter. No, that's something that you would be guilty, if you will, of what? Negligence for sure. And you would be held liable as well. So strict liability is a person is held responsible for intentional or unintentional actions, meaning you're responsible for both, whether you're negligent or you're not. So intentional, negligent, or unintentional, not negligent, things happen. So the strict liability. Vicarious liability is when a person is held responsible for the actions of another person. Your parents go away and they leave you with the keys to the kingdom. You're in your home, and what do? You have a party, and the party results in damages that we won't get into, but you get the idea. Your parents then would be responsible. So parents again are held responsible for child causing physical harm to another. Employers held responsible for employee causing damage. You're driving your employer's vehicle and you get into an accident. It's on your employer, the employer's insurance. That's a vicarious liability. Home and property insurance, again, now we're drilling down on property insurance again. Explain the insurance coverage and policy types available to homeowners and renters, homeowners insurance coverages. And this is what we're going through a laundry list, a checklist, if you will, of all of the items that fall under this entire insurance umbrella, if you will. So we're trying to identify certain things that will come up in the process of you selecting how much insurance you need, what type of insurance, what the coverages are. So we're drilling down on the coverages. And so the homeowner's insurance coverages in general, it covers the house and other structures on that property. So if you have a detached garage or tool shed, gazebo, trees, shrubs, and plants, and it depends upon if you have coverage for these items or not. So additional living expenses, meaning if your home is destroyed, will you have coverage to? Will your coverage include staying in a hotel or motel, etc.? Personal property at home while traveling. Personal property floater, high value items. So you identify those items and you make sure that if there is a loss, that you're able to identify those items that are lost. Household inventory, again, with that documentation, the aforementioned, especially with the high dollar items, right? So we're looking at that. And again, back to personal property at home or while traveling, meaning specifically for the home when you're gone, and also for you. This is an added item. It's for you when you are traveling. So it's the insurance that will be covering you as well in both your home while you're away and you while you're away as well. Medical payments coverages for minor accidental injuries on your property and minor injuries caused by you, family members, or pets. Your dog bites. Oh boy, that's a tough one. Most homeowners policy provide basic personal liability coverage of about $100,000 or more. An umbrella policy, this is the added name here is a personal catastrophe policy, supplements basic personal liability coverage, and it's called the umbrella policy for just that. It covers pretty much everything, and it increases your liability coverage from $100,000 to some number greater. In this case, they indicate $1 million. It could be quite a bit more than that, but at any rate, it all depends upon your needs. These are things that you have to determine. Specialized coverages, homeowners insurance usually does not cover floods or earthquakes. We have, again, flood insurance or earthquake insurance. Earthquake insurance is a tough one, especially if you're living in an area like in California. It can become quite expensive, actually. So or if you're in a flood-prone area, if you live along the banks of the Mississippi River or in Michigan, for that matter, there are a lot of areas, of course, that are prone to flooding, especially springtime, and we do have major rainstorms and whatnot that could bring flooding, and we've all either we've seen it ourselves, or we know about this firsthand. So you have to have specialized coverage in order to, insurance coverage in order to cover that eventuality, to cover that risk, if you will. Anti-current causation clause, these are just items that we're going through. So I'll interject a bit as I read through them, but just to reinforce, I am reading along with you, if you will. So it gives the insurer the right to reject your claim if your home is damaged by several factors at the same time, such as wind and rain, because they're unable to determine which factor came first and caused the damage. And this is the catch-22 for you as the homeowner or the property owner. It's indeterminate, if you will. Oftentimes, this is not typically applied because when you have major events, catastrophic events, it's typically not just yourself, it's your neighbors that are also impacted by this. But at any rate, things to keep in mind. Renter's insurance, so in addition to homeowners, this is for renters as well. It's important to have the insurance. So it's protection against financial loss due to the same things as if you were the property owner yourself. Loss of personal property, additional living expenses, personal liability and related coverage. A building owner's insurance usually won't cover renters' personal property, never does. So it's very wise, and it's not terribly expensive to get this. So just keep this in mind. Only 4 out of 10 renters have insurance, and that is because it's, for many, it's considered on the extravagant side, but it's usually, the reality is that this is something to take away. In the best case scenario, you pay your insurance and you never ever have to file a claim. Think about it. Meaning that if you have insurance on your vehicle and you never get into an accident, oftentimes people look at that and they say, "Oh, what a waste! I spent all that on premiums." But the truth of the matter is that is to offset anxiety that would be associated with the potential loss of that property. So that's kind of what you're paying for. You're paying for peace of mind that goes along with it. At any rate, so homeowners insurance policies. All risk, HO3, tenants form, HO4, comprehensive form, homeowners 5, condominium form, HO6, country home form, HO7. So typically, these are just different policy forms that will be associated with the insurance that we see in the book, of course. So home insurance cost factors. You analyze factors that influence the amount of coverage, and that's what we're looking into right now. So look for a policy with full coverage rather than the co-insurance clause where you have to pay a part of loss. So starting with, of course, what we're trying to do is to have a worst case scenario, see what the cost that's associated with a worst case scenario where you're not paying anything out of pocket and you're completely covered. And then you kind of pull back from that if it's too expensive. These are just things to consider, and this is the co-insurance clause as part of that. The claim settlement method, the actual cash value payment you receive is based on the current replacement. So this is replacement costs that I had kind of mentioned before. The damage or loss items less depreciation. so that actual cash value, it's replacement, but the items are depreciated. So if you have a vehicle that's parked in your driveway, for example, and that's a 5-year-old vehicle, and the car was completely destroyed, then it would be the replacement cost of that vehicle less the depreciation. So it would be significantly less, if you will, than the original price of the vehicle. This is the point, and onward we go. So replacement value, this is the more expensive type, if you will. You receive the full cost, repair, replace the damaged good or lost item. So if you have a Ford F-150 pickup truck, it would be the replacement cost for that Ford F-150 cost. So it doesn't take into account depreciation. It buys you a new vehicle, if you will, or pays for a new vehicle. This may limit replacement cost of to 400% of the actual cash value. So this is protecting the insurance company, for example, against having to pay too much. Is really what it is. This is all a balancing act on both sides, frankly. It typically costs 10 to 20% more than the actual cash value coverage. Again, it's very straightforward. Determining how much coverage you actually need. This is where we go through and this analysis, if you will, of how much insurance is actually required. So replacement value of the home, the value of the contents, protection from specific items such as jewelry. No one has furs anymore. Cameras aren't that expensive anymore, but you get the idea. The high dollar items, silverware or antiques especially. The liability coverage desired, and you go through this analysis, and it's something that you have to come to grips with on a personal basis, meaning these are your, how much is it worth to you to reduce your anxiety? How much anxiety can you live with is really what it comes down to, how much coverage you actually need. So the factors that affect the home insurance cost, location of the home, of course, type of structure. Brick homes are less to insure than wood houses, coverage amount and policy type. The deductibility affects that cost. So if you increase your deductibility from, we'll say from or if you increase your deductibility from $500 to $1,000, it will reduce the cost of the premiums because you are picking up your cost sharing in the event of some major catastrophe or some potential insurance claim, right? So the higher the deductible, the lower the premiums. Just very, very straightforward. Reducing home insurance cost, again, home insurance discounts, if you have such things as alarm systems, smoke detectors, fire extinguishers, if you're non-smokers, if you bundling, if you insure your car, etc., with the same company, you compare these costs because the cost savings can be significant, and this is something that you should be looking at on a periodic basis, because you can become complacent and stick with your same insurance company for a long period of time. But you should also be looking around to see if you can find something for a lower price. Having said that, you want to make sure that your coverage is reasonable, is decent, and these are things that you can look at. Again, the Consumer Reports is a good source, and of course it costs money to get the Consumer Reports, but just the same, nonetheless, it might be worthwhile if you're going shopping for insurance and maybe you're looking to buy a new car. Consumer Reports get a year subscription to it and let it lapse after that. Anyway, the point being, again, is that these are all things that you have to consider: the cost and also the coverage, meaning the likelihood that if you have a claim, how much your insurance company is going to, their first initial response is typically no, not responsible. You have to go find, it's difficult to do this, but finding a company that is reasonable. If you have enough, if you have enough data, if you will, information to back up your claim, it shouldn't be a problem. Anyway, this is where you start getting into murky territory. So automobile insurance coverage, moving from homeowners in general, we're talking about the same thing, but specifically now moving into automobile coverage. Identify the important types of automobile coverage insurance, the financial responsibility law, state. This is insurance and all other financial activities, if you will, are regulated at the federal level, but more specifically, it's typically, I should say, the state's responsibility to regulate the financial industry. And insurance is definitely something that, for example, in the state of Michigan, falls under the state regulatory, and under a state regulatory insurance body, the Office of Financial Services, I believe it's called. But anyway, financial responsibility. State legislation, nearly all states have compulsory automobile insurance laws that requires drivers to prove their ability to cover the cost of damage or injury caused by them in an auto accident. Automobile insurance coverage falls into two categories. Important: bodily injury coverage and property damage coverage. So bodily injury and property damage coverage. Okay. So automobile insurance coverage, 10,350. So 100,000. This is standard in Michigan, for example, for sure. It's a similar. This is the way it's set up. So 100, rather not. I think I said 10. Well, 100 indicates a $100,000 limit that will be paid to one person in an accident. 300,000 indicates that the limit that will be paid to all persons in an accident. So this is basic coverage. 50 is $50,000 limit for payment of damage to property of others. You get into an car accident and the vehicle that you hit, if you will. So let's just responsibility aside. But if your insurance is on the hook to pay for the accident, if you will, there's enough in essence to cover $300,000 in total, $100,000 per person, and $300,000 in total in an accident for the bodily injury if a person has to go to the hospital. Obviously, property damage is if the car is totaled and it's the replacement cost, if you will, is under $50,000 and you're covered. This is really what this boils down to. So motor vehicle bodily injury coverage is bodily injury liability. It covers the risk of financial loss due to legal expenses, medical expenses, lost wages, and other expenses associated with injury caused by an auto accident for which you're responsible. So that's the bodily injury liability piece. The $100,000 for an individual, $300,000 in total. Medical payments covers the cost of health care for if a person is injured in your automobile, including yourself. Also covers if you're injured while riding in another person's automobile or struck by an auto. So this is something that covers you or your occupants, if you will, within that vehicle, or within your own vehicle, or if you're in another vehicle, it covers covers your medical payments, if you will. So uninsured motorist protection. This is something that is all near and dear to all of our hearts. Covers the not. I'm just kidding. Sad but true. There are a lot of uninsured motorists out there. And insurance is not cheap, especially if you're young. Covers the cost of injuries to you and your family if your vehicle is hit by a person who is not insured. However, it does not cover property damage. Interesting to note that it does not cover property damage. No fault insurance, the system we have in Michigan, is intended to provide fast, smooth method of payment for damages without taking legal action where fault has to be determined. The drivers collect from their own insurance companies. And there's more that goes along with it, but we're looking at just in general. No fault insurance is that neither side is at fault, and you would turn to your own insurance company for remuneration to be paid, if you will, for your financial losses associated with that insurance claim. So motor vehicle property damage coverage, first is that we're looking at as a property damage liability. It covers damage to another person's car. So when you're liable, meaning that you are responsible to other person when you are at fault. It also includes damage to such things as street signs, buildings, etc. Collision is when your car is in an accident. So these are different definitions, if you will, as we're going through. So collision coverage pays for the damage to your automobile, regardless of who is at fault. If you are not at fault, your insurer will try and collect from the other driver's property damage liability first. This is called subrogation. So your insurance company is going to go after the other insurance company for the damage, if you will, that was done to your property. Coverage is limited to the actual cash value of your vehicle from an appraisal service. So this is very straightforward. This is, when we talk about actual cash value, if you got a 5-year-old vehicle that you took great care of and you paid $25,000 for it, and you're expecting it to last another 5 years, doesn't matter. You're going to be getting whatever the Kelley Blue Book value, or in this case, the National Automobile Dealers Association appraisal number comes up with, which is pretty close to the same, but you get the idea. It's going to be worth significantly less than $25,000. So if we're looking now, when we talk about comprehensive physical damage, we're looking at the overall. This is the umbrella policy, if you will. Covers damage to your vehicle that is not caused by a collision, such as fire, theft, vandalism, glass breakage, wind, hail, flood, tornado, etc., falling objects, hitting an animal, same things in your car, like radio, stereo equipment, or some things in the car, such things as things that are, again, radio, stereo equipment, they're not covered. But in general, when we're talking about the comprehensive physical damage, it covers pretty much everything on the vehicle or in the vehicle, if you will, aside from a few items as they're stipulated. But it's much better coverage. And in general, it's more expensive, but it's something to consider. Replacing a windshield, which happens in Michigan, or I don't want to say it, but there are cases of hitting deer and so on and so forth. This is where the comprehensive physical damage piece of it comes in. It's a little more expensive, but typically, again, you've got to determine whether or not it's a risk that you want to deal with, right? The deductible. So if windshield costs $200, $250 to replace, it's usually more than that, but you have a $100 deductible and you're comprehensive, then the insurance company will pay the $150. So they will pay anything above and beyond, typically, within reason, of course, beyond the $100 deductible. They will pick up the tab for that. That's what the deductible means. He said that's what's coming out of your pocket first, right? So this is something that's very straightforward, something that all of us should be familiar with. Okay. Typically, we think about it in terms of health insurance, but also with auto insurance as well. So other automobile insurance coverages, wage loss insurance. It's kind of a workman's compensation type of a situation where it reimburses you for any salary or lost income associated with your auto accident. If you're in a car accident and you end up in the hospital for a week or two, your wage losses will be picked up. So that's wage loss insurance. Towing and emergency road service pays for the cost of breakdowns and mechanical assistance. If you need a jump, if you need a tire replaced, then yes, everyone should know how to replace a tire. Most people don't anymore, but these are things that you have towing and emergency road service to cover, right? Anyhow, automobile insurance costs. This is always the fun one, right? So let's look at the factors. The amount of coverage. Legal concerns include having enough coverage if you were sued. So this is, again, that 100,000, 300,000 bodily injury with is kind of bare bones basic what you should have, and with the additional $1 million or more umbrella liability policy is recommended. And the reason we say more than $1 million if you can do it is that bodily injury cases, typically, if it's severe, obviously, the $1 million can be eaten up very, very quickly. Anyway, just something to keep in mind, not to scare you, but things to keep in mind, things to help you identify what goes into that insurance premium that you're paying, what it covers, right? So the amount of coverage, legal concerns, every state has laws that require encourage, I like that. Automobile liability insurance coverage, so you have to have liability coverage. Most can't afford to pay an expensive course settlement with personal assets, so drivers buy Automobile liability insurance, straightforward as that. Property value, the cost of vehicles have gone up. $50,000 to $100,000 is usually suggested for property damage liability. $50,000 does not go very far in replacing a vehicle, or if there's more than one vehicle involved, then it really quickly climbs right past that $50,000 price point, if you will. Anyhow, the insurance premium factor. So now we're actually paying the bill. We're looking at the type of the vehicle, the year, make, and model. So you have a 19, or excuse me, I shouldn't say 19 anymore. You've got a 2015 Chevrolet Equinox, for example. So 2015 is a year, make is Chevrolet, model would be that Equinox or Malibu or something along those lines. And then you look at, you go to your trusty actuarial tables within that, not you of course, but your insurance company would be looking at the theft rate associated with that vehicle. And oddly enough, oftentimes it's not the most expensive vehicles, but the most popular vehicles where the bad guys need parts for, that the theft rate goes up, right? So keep all these things to keep in mind. Rating territory, different costs due to the number of claims made in the geographic region area where you live. Driver classification, age, sex, marital status, credit history, driving record, and driving habit, all these things. And you're assigned a risk pool for people who care for the assigned risk pool rather for people who are unable to obtain insurance. These are people that are kind of go outside of the normal bell-shaped curve, if you will, in terms of their own driving habits and so on and so forth. So these are people that are kind of put beyond the normal insurance pool, if you will. So how do we go about reducing your automobile insurance premiums? Very similar to, improving your credit history, but comparing companies, you have to go through and compare. Comparison shopping is very important, and there are different sources. They indicate net quote, for example, here, and it's worthwhile. It's to your benefit to shop around, to get quotes. From all these insurance companies are willing to provide you with quotes. You have to have your criteria set up and make sure that you're comparing apples to apples. You want the same coverage across the board, when you're asking for these quotes. Premium discounts, establish and maintain a safe driving record, always a good thing. Avoid accidents, again, always a good thing. Traffic violations, reduce your number of tickets. Security devices, whether it's comes factory installed or you can install them yourself for relatively low price nowadays, and it's something that will pay for itself over a period of time. But these are all things to consider. Increasing deductibles. So can you live with a $250 deductible or a $500 deductible? It won't pay for, you'd have to pay for a new windshield, for example, out of pocket, but is it worthwhile? How often do you replace windshield? Think about these things. If you're a non-smoker, of course, that's always part of the part of the scheme, if you will, smoking, non-smoker. Insure 2 or more vehicles with the same company. Bundling your insurance, meaning your homeowner's insurance and your auto insurance, or your renter's insurance and your auto insurance, or if you have more than one vehicle, have both under that same company's insurance umbrella, if you will, right? Anyway,